What is options trading? Diving deeper in today's episode, we head into the stock market murkiness of options trading. What is it? Should you do it? Are you feeling overwhelmed by it? It's time to clear it up, because it really is not as tricky as it might first seem. But first, make sure you subscribe to our channel, hit that like button, and turn on all notifications so you never miss an episode or update. Now let's talk options trading. Options trading. What is it? Options, also known as stock options, are an asset class. They are contracts that give the bearer of the contract the right, but not the obligation, to either buy or sell an amount of some underlying asset at a predetermined price at or before the contract expires. Asset classes. For those not in the know, asset classes are what make up investor portfolios and include everything from stocks and bonds to ETFs and even mutual funds. Note: an ETF is an exchange-traded fund or a basket of securities that tracks an underlying index. It can contain investments like stocks and bonds. Stock options are another one of these asset classes. When used correctly, stock options can offer benefits and advantages that stocks and ETFs alone cannot. Stock option lingo. When you have the options to buy a stock at a certain price before a certain date, that is called a call. When you have the option to sell, it's called a put. If you've ever heard of derivatives, stock options are a good example of these, as they derive their value from the underlying asset. Note: a derivative is a security whose price is dependent on or derived from the price of something else. It is a type of contract between two parties that can trade on an exchange. Derivatives are generally used to access certain markets and may be traded to hedge against certain risks. Typically, a stock option contract represents 100 shares of the underlying stock. The price of stock options, like with all derivatives, is derived from fluctuations in the underlying asset. How stock options work in the real world. An example of a call would be investing in real estate. You see a new development going up, and after some serious investigation and speculation, you want to invest in one of the homes. You can buy a call option at a set price, let's say $400,000 for one of the homes, and you hold that option for, let's say, any time in the next 3 years. The developer benefits from you buying the call option because you will have to provide a non-refundable deposit. In this case, let's say it's $20,000. So, the developer takes no real risk in offering you the option and has a pretty good guarantee you'll buy the home if all goes well. Now, 2 years after you buy the call option, the housing market has risen. The value of the homes in that development has doubled, worth $800,000. But you're still well within your 3-year contract, and you decide to buy. You've lost nothing, and you've gained an asset that has doubled in value. Conversely, let's say 3 years go by and zoning approval still has not come through. You will need to either buy the home as it is anyway before your contract is up, stand to lose $20,000, or buy a new call option. An example of a put would be the flip side of investing. Think of it as insurance. You own a stock or index investment. The market is fluctuating wildly, and you want to be sure you don't lose too much money if the market drops. Let's say you own stock in an S&P index and you are unwilling to lose more than 10% of your current holdings. You can purchase a put option on that asset, currently valued at $2,500, giving you the right to sell the index if it drops to $2,250 at any point in the next 2 years. 6 months later, the stock market crashes and the asset is now worth only $2,000, but you were able to sell it at $2,250, so you saved money and have a combined loss of only 10%. Of course, there's no free lunch on the stock market, and you will have to pay a premium in order to buy the put option. But in the end, if all goes well and your stock does not crash, you only end up losing the premium you paid. In both cases, call or put, you are doing what is called hedging your bets. You protect yourself, making sure you can potentially make an investment that will pay off in dividends without fully investing upfront, or making sure you don't lose everything in a volatile market. Where can you purchase stock options? Like with any other asset, you can buy options with a brokerage firm. Remember, like with everything else on the stock market, there is inherent risk in working with stock options, and you are always better off wading in slowly and only investing what you can afford to lose. To sum up, stock options are assets on the stock market that allow you to hedge your bets or investments. You can buy the call option, which offers the right but not the obligation to buy an asset, or the put option, which offers the right but not the obligation to sell an asset. The only real risk involved is loss on the down payment or premium you pay up front, which in the long is a much better risk to take than total loss of investment. Now, before you go, remember to hit that like button, subscribe to our channel, and turn on all notifications so you never miss a show.